Eric Mother with Mother.com with the U.S. market analysis for the weekend of April 23rd and April 24th, 2016. Let's take a look at markets here, and the Dow is down with about 1 hour to go. I guess up slightly. NASDAQ is down about 0.86. S&P 500 unchanged. Gold is down 1.4 and crude oil is up 1.2, and the VIX surprisingly continues to be down about 3.6%. Let's go straight to the charts. We begin by taking a look at the NASDAQ weekly chart, and clearly the resistance level we've been talking about the last couple of weeks continues to be a problem for the NASDAQ. A simple line connecting RSI highs shows that the market continues to struggle every time it tries to move above that level there, recently forming a double top. So until such a time as we can move above that resistance line on the NASDAQ, one can continue expecting the market to pull back. And of course there is the line connecting the break off the highs. So this break here for the NASDAQ sometime in July of 2015 off the highs there. We've been drawing a line from there, and the market still has been unable to move above that red line. The last time we hit that red line was the highs of October, December, and coming back to test that same line here in 2016. We have still not been able to move above that. So net, given this chart, until we can move above those two lines, one has to assume that what the market is saying is that week to week, we are right now looking at a market that wants to go down. On the NASDAQ daily, in the short term, we can see that we did make a higher high in short term. While that was taking place, we see that the RSI made a slight lower low or lower high. So that negative divergence could be the reason why the market is pulling back. Now, of course, the market had finally moved above the 200-day moving average. So if the market can come here, find support at the 200-day moving average thereabout, somewhere here, and start moving higher, maybe the market eventually can have a chance of trading above the recent daily closing high. So, this chart, short term, little bit of a negative, but not broken, because we continue looking at a market that is net trading above a stabilizing 200-day moving average. So if we can bounce off that and move higher, that's good. Otherwise, moving back below that 200-day moving average might scare some people, and the market could see a pullback. If I take a look at the hourly for the NASDAQ, there's a chance here that the market could actually be holding together, and it is a line coming from the hourly chart. If you take a look at where the market did move higher, as you can see here, coming off this line here. So this little bit of a move off the lows of February when the market was seeing lower prices. We've come off those lows, so draw a line from there, and as of right now at the lows for the day on Friday, we can see that the market has been back to this line. We seem to be holding. That is good enough support on an hour-to-hour basis. Take a look at the other areas where the market bounced on this line. We hit that line there and we bounced. We came close here and we bounced. We came close here and we bounced, and now we are holding back above that green line. So hour to hour, it might explain why the market has come off the lows of the day. If we take a look at the Dow hourly, and here I'm using RSI setting of 26. So on the short-term charts, I'm using RSI setting of 26. What you see here as far as the Dow is concerned is a simple line connecting the lows, going back to the lows of 2016. Nice support here during the lows of Friday's action. So net, as long as the markets are holding above this line of support, and this line has been holding the market even during the lows here of the month, and going back to the lows even here during what was positive divergence as the market made fresh lows, slight lower lows here, or an attempt to go lower, but the market responded with improvement in the RSI here. So that positive divergence could be the reason why one can say the market had a nice bounce. And now, as long as we are holding above the blue line, which has been support, one can expect that the market should be okay. It's only when we break through that blue line of support that finally we can start seeing the market start to lose some ground. If you take a look at the 30-minute chart for the Dow, you can again see another line which corresponds off the lows of February there, and the RSI did move above that level. The slight movement in the RSI does generate a line that we can use for bounces, so just draw it like that. Every time we bounce on this green line, you can see that the market has been responding with a bounce. Even here we bounced, we held here for the lows there, and now during the lows of the day on Friday the market hit that line and we seem to be bouncing. And there's another line also on the 30-minute chart here for the Dow, just a line connecting RSI lows. As you can see, I hope you can see that, is that every time, so the line connects these lows, the lows there, and connects to these lows and also to the lows of Fridays. So we can see that on the 30-minute chart and also on the hourly, until we can break the support lines, the market should be generally sideways or even have an attempt to move higher. If we take a look at the Dow Transports, which does give us a good reference point here, there's a recent high for 2016 on a weekly closing basis. The level to watch there is 8075.69. It's a very simple line here. What the market needs to do is break out and hold above that level. If it's a big if the market is to see higher prices, it needs to take out that very clear and obvious recent weekly closing high. If the market cannot hold above 8075.69, that would suggest that the market is not as strong as it might seem. But above this number, and one can assume that the market still has the opportunity and the chance of moving higher. So it's a simple strategy here. Above this recent weekly closing high, the market should be bullish. Otherwise, anything below that number and the market can be looked upon as being bearish. Now, if we take a look at the RSI on the weekly, we really come to one conclusion. A, this is the line connecting recent RSI highs going back to 2014, connecting all these highs, even here, and recently we touched that level there for the highs there, and now we are coming back here. So until we can break out above that top side resistance on the weekly, this market is suspect. There's also another line which goes back to the break. In fact, it goes back to a simple break on the weekly chart. During this break here, this weekly movement lower corresponded with the RSI breaking down right here, which happens to be sometime in May. So once we broke through that, we can see that we can draw a line from there, which happens to be where the weekly chart is trading right now. So somewhere around there. So we need to be above those two lines if the market is to move higher. Otherwise, if we show confirmation of resistance on those two lines and we start coiling back down, keep in mind that if we coil back down, that would confirm that the market is actually showing a short-term double top on the weekly RSI here on those two lines. If we can't move above the current closing high for 2016 at 8075.89, if we can't move above that number, the Dow Transports, and if this is confirmed as resistance, one has to assume that the market is telegraphing that the next move is lower. Otherwise, if the market is to move higher, we need to clear those resistance levels. And of course, so if the market is truly strong, we need to see the market clear resistance by moving above this line there or that closing high. We also need to see the market clear resistance based on the weekly RSI topside resistance line. So needs to clear that line and also needs to clear the RSI resistance line. Unless those three things happen, this market should be suspect and one can expect a move lower in the coming weeks. Take a look at the S&P 500. and we can see again here nice support on the hourly going back to the lows of this year. It's a simple line connecting recent lows, and so clearly here on a short-term basis this market should be okay until such a time as when we break below this line of support. So in my opinion, market looks good on the short-term basis until we break down below the hourly support. This is also consistent with the VIX. If you take a look at the VIX continues to struggle every time it tries to move higher. In fact, there's a simple line connecting RSI highs on the hourly, so something like that. Until the VIX can move above this line of resistance, one has to assume that the general market hour to hour looks okay. So until the VIX can finally clear that line by moving above it, we have to assume that the market should be stable to sideways. If you take a look at the long-term picture for the S&P 500, we've been talking over the last couple of weeks and months about the possibility of the market making new all-time highs. Why? Because the RSI did bounce back above its 50 level on the monthly chart. So here, over the last couple of months, we've hit that line on the 50 twice, which gave us this recent low. Over the last 25 years or so, every time the market bounces on the 50, you can see that every time the market goes on to record new highs. We also bounced off the 50 here in 94-95. The market went on to record new highs. Same thing in 98. We bounced back above the 50, did not even move below the 50, and the market went on to record new highs. And also coming off the lows of 1990, you can see that the market bounced on the 50 on its monthly chart and went on to record new highs. So here, because we held the 50, the speculation was that there's a likelihood that the market could very easily be positioning itself to go to fresh new highs. So on the monthly, let me give you the level to watch for the S&P 500, and it is this all-time monthly closing high there for 2015, and the level to watch there is 2107.39. Should the S&P 500 finally move above that number, just gotta be aware that this market has the potential to break out and record substantially higher levels. So a breakout here is pretty much the biggest fear for bears, because if the market can clear that resistance, you never know how high it can go and for how long it can stay at lofty levels. So that's the level to watch for the S&P 500. Anything above that is absolute scary if you're bearish, and it's a good thing for the market to break out if you're bullish. For the Dow, it needs to clear this 2015 all-time monthly closing high, and for the Dow the level to watch is 18,132. So 132.70. If it can clear that all-time monthly closing high, you really have to be careful here not to be short the market, because a breakout market could go on to record much higher levels. In conclusion, a little bit of a confusing market here. The hourlies are good, the weeklies are suspect, but net I'm gonna lean, if I'm forced to take one side, that until the NASDAQ can move above this line of resistance, I still believe that the market does struggle. So until the NASDAQ can clear this line, the top side resistance, and until it can clear the previous break line right there, until the market clears those two lines, net I think one can position themselves short, with the idea that if the market breaks out on the monthly, to get out of those shorts. Eric Mother.com. So leaning short for now, in my opinion, if I was to summarize what I think the market is trying to do. Otherwise, we shall see. Good luck, enjoy your weekend, peace and blessings. I am out. Mwah.